Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Roku stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Roku offers streaming media content from various online services. The first Roku model, developed in collaboration with Netflix, was introduced in May 2008. Roku devices are viewed as influential on the digital media player market, helping to make popular the concept of low-cost media consumption. Roku has also licensed its platform as middleware for smart TVs. I personally use Roku on all my TVs. Instead of paying for each cable box, I was able to return them back to Comcast and put a Roku device, which saves me $50 a month on my Comcast bill. The COVID-19 pandemic has accelerated the shift of TV viewing away from traditional TV to streaming TV. During the third quarter of 2021, Roku had an increase in the number of active accounts, but the growth rate was slower than in the prior period last year, primarily due to global supply chain disruptions that caused an increase in TV prices and a decrease in TV sales. Active Roku accounts increased to 56.4 million as of September 30th, 2021, compared to 46 million as of September 30th, 2020, growing 23% year over year. Streaming hours increased to 18 billion, growing 21% year over year, and growing 4% from the second quarter of 2021. The company is headquartered in San Jose, California, and was founded in 2008. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 31 billion market cap. They're trading at $2.32 a share, and they have 134 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see their free cash flow was negative in 2018 and 19, and then it was positive for the first time in 2020. Once you get past through that break-even point, then your margins grow even faster. Their free cash flow nearly quadrupled from 2020 to the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year except in the trailing 12 months. Revenue is the sales for the company, and that more than tripled from 2018 to the trailing 12 months. They're growing at an unbelievable pace. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew a lot from 330 million to 1.3 billion. Below that is their operating expenses, which are all the expenses not directly tied to generating the revenue. And below that is their operating income. And they had a big positive in the trailing 12 months. It was negative every year before that. And the bottom line of the income statement is their net income. This is the company's income statement from their quarterly report. This is the first 9 months of 2020 versus the first 9 months of 2021. And the third quarter of 2020 versus the third quarter of 2021. They break out their revenue by platform and player. Platform is the bulk of their revenue at 582 million. Player is 97 million. And their revenue from player went down, actually, but their revenue from platform went up a lot. Their platform revenue increased 82% from the third quarter of 2020 to the third quarter of 2021. And even more impressive, their average revenue per user grew to $40. That's up 49% year over year. So each user is spending more money. Adding users is important, but equally as important is getting users to spend more money on your platform. The revenue from platform is digital advertising. The more users the company has, the more money they can charge advertisers. Content distribution services, subscriptions. They earn revenue per transaction. Branded buttons on remote controls. Also licensing arrangements with service operators and TV brands. The player revenue, that's revenue generated from the sale of audio products and accessories. That's through their retailers and distributors, but they also sell through their website. They had 583 million of revenue in platform, and the expenses tied to that were 204 million, so the margins are pretty good, but they're actually losing money on the player revenue. They brought in $97 million and it cost them $112 million. So maybe that's why they're scaling down their player revenue and trying to focus on their platform revenue. Last year, the player revenue covered the player expenses. Even in the trailing 9 months, they're losing money on player revenue. You can see in a gross profit, it's negative for player revenue. They spend $120 million in R&D, $109 million in sales and marketing, and $65 million in G&A. They're just starting to become profitable. They're bringing in positive operating income. In the first 9 months of 2020, it was negative $85 million. They spent $743,000 of interest on their debt in the third quarter. Their net income more than 5x'd from the third quarter of 2020 to the third quarter of 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they were generating a little bit of cash flow in 2018 and 19, but then it's been growing a lot. It grew 10 times from 2019 to 2020, and then more than doubled into the trailing 12 months. They do have to acquire content, so they spent $34 million in CapEx in the trailing 12 months. It was over $80 million in 2019 and 20. Operating cash flow minus CapEx gives you your free cash flow, and they did bring in a decent amount of free cash flow in the trailing 12 months. And that's going to probably be growing a lot in the future. Since they had negative free cash flow in the past, they were using stock and debt to run their business. They issued $500 million of stock in 2020, $1 billion in the trailing 12 months. When a company issues common stock, it increases the shares outstanding and makes your shares less valuable. And they also added $100 million of debt in 2019 and $70 million in 2020. But they did pay down $74 million in 2020. They do acquisitions every year. You can see their CapEx was $34 million in the trailing 12 months. Their investing cash flow was $171 million. The reason for the big difference is due to those acquisitions. This is their operating cash flows from the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement. Then adjust for changes in working capital. We start with $219 million of net income. We add $31 million of depreciation, $133 million of stock-based compensation. We add $22 million of amortization of right-of-use assets. A right-of-use asset is when Roku leases an asset that another company owns. For accounting purposes, it treats it as if it owns the asset. That's why it amortizes it. And if it's an operating lease, Roku will give back the asset at the end of the lease. If it's a financing lease, then Roku would retain the asset at the end of the lease. We'll look at their balance sheet later, and it'll show these are operating leases, not financing leases. And then we have to adjust for changes in working capital. It looks like they extended $65 million of credit, so that's a cash outflow. They bought $22 million of inventory, that's a cash outflow. They purchased $15 million of products on credit, that's a cash inflow. Even though they reported a $219 million accounting profit, they actually brought in $253 million of cash flow. Last year, they reported an accounting loss of $85 million, but actually brought in $101 million of cash flow. That's why I like to look at cash flow from operations. I think that's a better indicator of how the company's doing than net income. Let's look at their investing and financing section. This shows us the first 9 months of 2020 versus the first 9 months of 2021. Their investments in property and equipment was $28 million. Last year was $76 million. They spent $137 million in business acquisitions. They acquired Nielsen and This Old House. So in their investing section, they had a cash outflow of $165 million. Last year was a cash outflow of $75 million. In their financing section, they raised $1 billion in an at-the-market offering. Last year was $500 million. An at-the-market offering is a way for a company to issue common stock at the current market price. If a company needs fast cash, they'll do an at-the-market offering because it's faster than a traditional secondary offering. They didn't add any debt this year. Last year they added $69 million but paid down $73 million. They did pay down $4 million of debt this year. They raised $13 million from employee incentive plans. So in their financing section, they had a cash inflow of $1 billion. Last year was $500 million. This is the equity section on their 9/30 balance sheet. They have $2.7 billion of equity. They raised $2.8 billion from selling their business, and they lost $113 million from running their business. Let's look at the capital structure. They have $2.7 billion of equity, $500 million of debt. They're 84% equity, 16% debt. and their net debt is negative 1.7 billion. So they could pay off all the debt with the cash on their balance sheet and still have 1.7 billion of cash left over. I gave them the lowest WACC, 6.31%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 21 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 134 million shares. And we get a calculated stock price of 135. They're trading at 232, so they're trading at a 71% premium. It's a sell according to the model. Their revenue is projected to grow 25%, so I grew it 25% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. And that comes out to 15%, so I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. Simply Wall Street values the company at 318. They're saying it's 28% undervalued. 20 analysts price this stock and the average price target is 364. A simple way to value these types of companies is look how many active users they have. You'll notice the companies with the most users are the most valuable, like Facebook. You can see each quarter they're growing their active users. It only goes up every single quarter, so that's a good sign. Also, the average revenue per user is going up a lot. It broke through $40 for the first time. It was under $10 a few years back. So if a company is growing a lot, why do I say it's so overvalued? Just because something is valuable doesn't mean it's undervalued. If you love steak and your favorite restaurant where you get steak from generally charges $20 per plate, but on Valentine's Day they charge $90, just because you love steak at that restaurant doesn't mean you're going to buy it. And if you hated salmon and that restaurant was charging $5 for salmon instead of the usual $20, doesn't mean you have to buy it because it's undervalued. Same thing with a stock. Just because it looks good doesn't mean it's undervalued. The stock did peak a couple of times at close to $500 a share, and now it's cut in half. People usually buy stocks well before the company's successful. And when the company becomes successful, there's usually a sell-off. And then sometimes the stock languishes for years. Other times, like Tesla, it just keeps going up. But if you wait for the company to become successful, that may be too late to make money. Although the stock is cut in half now, so it is a much better deal than it was a few months back. But if you buy it now and it goes down to 150, you're going to be annoyed. But nobody really knows when the bottom is. There was so much trading activity in the beginning of 2020. There's still a decent amount of trading activity. All the smart investors got it down here. That's why there's so much activity. And once the stock got really high, there was a big sell-off. Then surprisingly, it got back up to where it was before the sell-off. But now there's been an even bigger sell-off. Plus, the market has been regressing the past month, so that probably hurt the stock as well. Their beta is 1.7, so the stock is a little volatile. It moves a little less than 2 times the market. It's gone down 36% in the past 52 weeks, while the S&P is up 24%. The 52-week low was 190, the high was 490. And the stock is trading below its 50-day and 200-day moving average. Lots of activity on this stock the past 10 days. Nearly 11 million shares traded each day. 69% of the shares are held by institutions and over 4% of the shares on float or shorted. A good sign is they're adding employees every year. They're up to 1,900 workers. If you invested $10,000 into this company when it IPO'd, you'd be really happy at $86,000 today. That's a 66% annual return. Your $10,000 would have been close to $160,000 a few months ago, but still, multiplying your money by 8.5 is still really good. Investors don't like to see insider selling. There's been a couple of sells recently, one for 1,000 shares, one for 16,800. 60% of the shares are held by institutions, 27% by the general public, and 12% by insiders. The founder and CEO of the company, Anthony Wood, owns 12% of the stock. His value is close to $4 billion. Fidelity owns 7%, then Vanguard, BlackRock, and Cathie Wood's ARK. Let's look at their financial ratios. They have a really high PE at 109. A company that has a high PE is expected to grow a lot. They have a pretty high price to sales at 12.2 and a high price to book of 11.6. With such high price multiples, the market is saying the stock price should go up a lot. Here's a list of their non-current assets. Property and equipment of $171 million. This is net of depreciation. We talked earlier about right-of-use assets. These are operating leases, so they will not retain the asset when the lease expires. That's $347 million. $92 million of intangibles, $147 million of goodwill. When you see goodwill on a company's balance sheet, that means they definitely acquire companies. And since they have $147 million of goodwill, they probably acquire a lot of companies. And other non-current assets of $194 million. They have a high return on invested capital of 22%. They can easily cover their interest payments. Their ROE is 11%. And they have a high current ratio and quick ratio. They have lots of cash on their balance sheet, $2.2 billion of cash, $600 million of accounts receivables, $76 million of inventory, and $110 million of prepaid expenses. They have $132 million of accounts payable, $482 million of accrued liabilities, and $46 million of deferred revenue. Deferred revenue is when a customer pays for a product or service in advance. So it's carried on the balance sheet as a liability, but when Roku delivers the product or service, they'll take it off the balance sheet and book it onto the income statement as revenue. They seem to be really well capitalized. They're now generating positive free cash flow, and they have $2.3 billion of working capital. Working capital is current assets minus current liabilities. So they have over $2.5 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 9 companies in the same industry as Roku. And if Roku has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in all the price multiples. They have a high current ratio. They do have a positive ROE. The average in this industry is negative, mainly because 2 companies have such a poor ROE. They're a lot lower than average in debt. And they're a pretty decent sized company, but they're smaller than average because you have Netflix and Disney in this industry. So to summarize, I have them trading at a 71% premium. I personally love Roku because it saves me $50 a month on my Comcast bill. And Roku is more than a smart TV, it's a better TV. The Roku TV offers a really customizable home screen. And you could pull up any app. I have Netflix on there. And it's just one remote that works on everything. So you can watch TV shows, movies, and it gives software updates as well. Roku offers new free features and the latest streaming channels. If you compare Roku with Fire Stick, Roku has more channels and apps, and Roku has a lot of free content. So overall, it's much better than Fire TV Stick. Given everything I just said, I still think the stock is overvalued. I think it has a lot of room to come down, but that's just my opinion. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.